Okay, I'm gonna add myself to the stage there. Let me see if you guys can see me. So today we're gonna keep it tight, 30 minutes. I want to cover two things. I want to do a portfolio review, just kind of give you insight into my trades, why I made them. I'm gonna leave the comment section open for any questions that you may have. If I don't get to them during the live, I will address them in the next stream. Any question you may have, doesn't matter how basic, how complex, how opinionated, anything, just let me know and we can address it together. For those that are new, the purpose of this channel is really to grow this account slowly and with minimal risk. A lot of people, including myself, these funds, it took a lot of sweat and tears, and the last thing you want to do is lose them. So the main philosophy behind this account is capital preservation, making sure your risk reward is there, and making sure that it's all worthwhile as well, right? You don't want to go through all this trouble just to barely beat the index. So that is the point of this channel, brick by brick, just explain kind of the individual trades and how you can also get into option trading. That's the idea. The idea is for us all to ride the bicycle of option trading and learn as we go. So currently, let's go ahead and dive in. The markets right now are they're volatile, but they're also pretty, I would say, stable in the sense that there hasn't been any drastic spikes. I think everybody's kind of holding their breath for the rate reductions. If we were to go right now to Polymarket, which is sort of like the biggest, I guess, reflection of what the capital markets are expecting, mainly because you do bet with your money on this website. And right now we have about a 50. It's funny though, because the 25-point decrease, right, was probably the one that was leading, right? And if we look at the graph here for the past month, we can see that there was about 76% chance, even at one point a 90% chance that the 25 was going to be the one that was pretty much a sure bet. But ever since we've started getting the Fed data, the unemployment numbers got revised pretty drastically. Companies are kind of doing some labor cuts. There's been a lot of pressure, even some politicians pressuring the Fed to do 75 basis points. And so because of that, 25 basis points is kind of not even, it is fully priced in. I think 25 basis points is what's priced in. And I think that 50 basis points has also now recently gotten priced in to the point that if we don't get 50 basis points, I think we'll actually see a bit of a little bit of a red reaction or a stable reaction. There won't be any drastic changes. I think if we do get a 50 basis points decrease, I think the market's going to go up maybe 1% or 2% in the week or during that day. If we see a 75 basis point reduction, I think it's just going to completely go through the roof, and we're going to see some pretty crazy volatility on the upside. And I think that if there's no change, so if they leave the interest rates the way that they are, which is really a 1% bet here, so for those that want to bet on this, it's a pretty good payout. The reality is that the Fed has to do something, and I personally think they shouldn't. I think that there should be no change. I think that it's, right before elections. The next decision will be after elections. So it gives them time to not look political. But, the Fed is separate from the executive branch. So technically there is no pressure, or they shouldn't entertain any political pressures to reduce rates. We're going to see what happens. Long story short, nobody knows. So the whole point of trading now for us is, how do we prepare for both scenarios? How do we prepare for, I really don't think the no change is on the table. So I don't think there will be a hard red. If there is a no change, I think we'll see a pretty decent correction in the market. But I really don't think that's on the table. I think it's really either between 25 basis points or 50 basis points. And so because of that, I think we should really just kind of prepare for either the stock market going green or it's staying stable, possibly slightly red. So let's go ahead and kind of go through Actually, you know what? Since we're talking about the federal decision here and the Fed interest rate decision, let's go ahead and look at something that I looked on X and I found it pretty interesting. And I figured, you know what? Let me go ahead and share this with you guys as well. Let me see if I can find it here. There you go. So pretty much what this chart here is showing is what the reaction of the stock market or the reaction of the S&P 500 was shortly after the rate reductions back in 07, 08, when they also had to raise interest rates and started reducing them, right? So you can see here in September, they reduced rates. There was a pretty decent rally, and Nelson Cover here, who I don't actually currently follow, but I am going to follow him, pretty good data. He says here that it rallied 2.5%, 2.8, almost 3%, and then a total of 6% for the next 23 days. So I guess he's talking from September to this hike right here. So 6% hike in the next 23 days. Then there was the second rate cut, and then the market kind of started correcting. Second rate cut kind of gave it a little bit of a bump. It went back up, and then you see it really rallying right before the rate cuts, but these gains not really sustaining any of the gains, right? And so I personally think we're going to see something similar. You know, I do think tomorrow we are going to see some, you know, there's a lot of optimism in the market. There's a lot of, okay, we're back on the good track. You know, we're back on rates going down. You know, there's a lot of pressure on the commercial real estate side, on the federal interest side. Everybody's paying a lot of interest payments, high interest payments on debt. So generally reducing the Federal Reserve rate is looked upon favorably because that means that companies that have high debt or that have debt at high interest rates could refinance that debt at lower interest rates, and therefore their cost of debt, of servicing that debt, is lower. That's really kind of the background story on why it's so optimistic to look at it. But the reality is that in that face of the optimism, you have a deteriorating economy. You know, you have an economy that has less job openings, less full-time employees. People have less disposable income, higher credit card balances. And so the question is, you know, which one is going to overshadow the other? And that's why you see, really, while the rate reductions make it go green, you see it, you know, react red after a longer period of time, because the economy is deteriorating, and you want to make sure that, you know, you keep it real, you know that that's what's happening. So let's go ahead and go into the trades. So right now, right, we are doing pretty good year to date. We're up about 42%, phenomenal return. So what I've been doing is, in preparation for this Federal Reserve hike, I've been reducing the amount of margin that I use, specifically on riskier trades, sort of like miners and companies that are very volatile, because we don't know how Bitcoin's going to react to the federal rates going down. You know, it could be as simple as, you know, market's gonna, the capital is gonna flow from Bitcoin to the S&P 500 and the stock market, with the idea that because rates are going down and it's gonna rally, people want to partake in that rally, so they move their money out of crypto. But it could also mean, hey, you know what? Maybe we don't want to be in that volatile environment. We're gonna actually move money out of it into crypto until the stock market is more stable. So we don't really know what we're going to see, but what I can tell you is that it's going to be volatile. So you want to protect your capital, and you want to protect your margin even more, you know, specifically margin. So you want to make sure that if you are using margin, use it for stocks that you feel comfortable will be able to survive and not be so volatile during this period, right? So enough of a rant there. Let's start going into my calls. Here we have Amazon. This is a call that I had purchased and a call that I had sold. Now you can see that they're both expiration dates. This is what you call a poor man's cover call, right? So essentially I had bought that long dated $30 call and I had sold calls on it. I am now at the end of the string with the call. Now, luckily, AMZU, which is a leveraged Amazon play, is at $33.15. So technically what that means is that it should be getting called away on the 33. So just on this part of the trade, right, essentially what's going to happen at the end when these expire on 9/20 is the system is going to purchase these calls at 30, right? Because that's really what this call is saying is, hey, I control 100 shares at $30, but then they're going to be called away at 33, right? So that's a $300 profit right there. But I don't participate in the 15 cents because I'm getting them called. So I'm buying them at 30 and I'm giving them away at 33. But essentially what I'm doing is I'm just trading the contracts on that. So I don't actually own the 100 shares. Now I also keep the premium I collected for $80 on the $33 call. So it's really 380, right? So now you're saying, okay, you're making 380, but this call cost me 590. Yes, but also remember, I bought this in 7/18. So I've been selling calls against this option for close to 2 months now. So I don't have the spreadsheet in front of me right now, but the return is pretty decent and I'm okay with it. So this is now a trade that's nearing the end of its life. As long as it stays above 33, I should be doing fairly well. CleanSpark. So CleanSpark is, I think you all know the story with CleanSpark, but essentially I got caught underwater with CleanSpark fairly heavy. My basis was $17. Back when it was at $17 is when I was selling puts on it. So back when it was like around here, I was selling puts and then this happened. And basically the premiums were very good on it. So long story short, while my basis here, it says 15 because I bought another 100 shares to lower my basis. My cost basis, because of all the options I've been selling on it, is about $12.80. So the idea between CleanSpark right now for me is really just to keep wheeling it until I get to $12 or $13 and at least get to break even and then decide what I'm going to do with it. As you can tell here, I have two 9.5 calls that I sold for, I think, about $26. So I'm currently up on these. I have a $10 call that is expiring this week as well, 3 $10 calls. And then I have an $8.50 put that is also going to expire not this week, but next week. And this is one of those strategies that I shared with you guys where I essentially, I believe I owned 5 or 10 at some point. I got rid of about 4 of them. I have 1 left just to keep track of where premiums are. You see here, I got $53 back on the 3rd of September. And right now it's worth 30. I believe here you can see that I had bought back 4 at 32, right? So if I bought them back at 32, if I'm going to sell more on them, I'd really like it to be above 32. So right now I'm just letting this one ride. Maybe what I'll do is I'll reopen this same play, but just with more time. This has till the 27th, so it has about a week and a half left on this, right? So this is just something I'm keeping an eye on. What else do we have? Intuit. We'll leave Intuit. Actually, you know what? Let's get into it. So Intuit is pretty much what I'm doing is the poor man covered call. Essentially what I did with the Amazon play. So I bought long dated calls and I'm selling calls against it. So right now you can see that this particular play, right? So when you open up the actual play itself, you can do it in, that's why it looks like it's a 2 option strategy because I did it all in the same instance. And what I did was it buys a December call and then it sells a shorter dated call to offset that premium and it packages it into one. Now, the reason why I don't like technically doing this is because if I want to roll this leg right here, so the 635, let's say I want to roll just a 635, I actually it doesn't let me roll it. I have to do it manually. So I have to go into here. So 635, right? Right now, this trade is technically underwater because I own shares from 690 upwards. So right now that I'm selling 635s, that means that I would be responsible for that loss if it's from 635 to 690. And that is very risky. The reason why I haven't rolled these 635s, which are obviously underwater, is because I'm waiting to see what the reaction with the Federal Reserve is tomorrow. And shortly after that, I'm going to go ahead and roll them. So I'm literally going to have to buy to close, and then I'm going to have to buy to open, and I'm going to do that for a credit. So you know what? As a matter of fact, let's see if maybe we can do some right now. I have a position of, I have 6, right? So you should always nibble in and out, and that's a strategy that you will eventually learn, but you should always nibble in and out. If you're going to get out of a trade and the trade fundamentals haven't changed, don't do it all at once, because you never know if it's just going to continue going up or continue going down, and you leave money on the table, or you don't, So for this, for example, tomorrow, who knows what happens tomorrow? But what I can tell you is that I'm just going to do 2 shares out of the 6. So I'm going to take 2 out of the shares that I have here, 2 calls, which right now are trading at, the last trade was at 1509. It seems like the middle mark right now is 1640. So I'm pretty sure if I offer, let's go ahead and see if we offer 15, what happens, right? So we're saying, hey, we're going to buy 2 of them at 1500. So that's $3,000 flat. You can see our bid right here. The last trade was 1509. So you know what? Let's go ahead and actually dismiss. Let's see if it fills. You've got to be patient with these things. Right now, Intuit is basically coming in and out of red and green. That's why it's so volatile. Right now, it's green. It's up 0.04. If this turns red, I know for a fact this trade's going to fill. So sometimes you just have to be patient and wait to see what happens. So we're looking at 15. Let's see what's going on here. There's only 3 people offering 15. 2 of those are mine. 1509 was the last trade. So look, just an effort of making this trade happen. Let's do 1530. Let's see if that is enough to tip the scale. So there we go. We filled them up at 1530. Right? So 1530. And so now what I'm going to do is I'm going to go to options. I'm going to roll them out maybe 2 weeks. And then I'm going to sell a call, and we paid 1530, right? So the idea is for it to be at least at a gain. So what I'm going to do here is I'm going to do, let's do maybe 17. Let's see what the 645s look like. Ooh, let's do 1. And the previous one was 1625. Let's go to 17. Let's see 1750. $17.50 isn't really going. So let's do 17. Shh. And we see right now it turned red. So that's why the premiums on calls is a little lower. Now it's between 16 and 17, and we're offering 17. Remember, we paid 1540 for the other one, and it was at 635, and we're throwing this all the way to 645. So we're buying ourselves about $10 worth of capital appreciation, right? And we're also trying to collect some premium. Let's see what that amount is going to be looking like. 16. We did 17, right? So let's do 1680. See what that looks like. Even 1680 isn't filling. Right now we're at negative. It's down right now, 645.70. 1680 is the top of the range. People are saying, no, I want to pay 1620. We're at 1680. So, if you were to go right in the middle at 1650, you may be able to get away with it. For the sake of doing this trade, let's just go ahead and see. And you know what? I may actually leave one of them. $16.25 was the previous close. Let's do 17. $17.20. went down a lot, negative 0.14. I mean, not a lot, but it definitely affects the option chain here. All right, let's see. Let's see. For the sake of this live stream, I want to make sure we at least sell one of those calls. But you see, the idea is that now I have to reopen the call, higher strike. You always want to be above, or you try to be above the call that you purchase, because that's where you're covered. And if you guys have enough comments, I can definitely do a deep dive into the Poor Man Covers Call campaign. If you guys follow TJ the Wheel Deal, he's pretty, you see, so now we're going down into 0.17s. So maybe, I don't know if we're going to be able to get what we want. You see how this is now 1380. It's very, very sensitive to the price reductions on the actual underlying stock. You see now it's 1650 to 1410. So, maybe what we'll do is, now it's at 644.96.20. Maybe what we'll do is, let's look at Intuit real quick. 1 month. $644.96. It looks like it's going to fall off the cliff there. Where's the pending orders? So look, one of them just executed. At 1650. So then this one, this one, 1650. So 1650 is what we just sold it for, and I had closed the other one for open order. Where is that? Yeah, these 635s, I think we paid, what was it, 15 and change for it? Let me see where it is. So we bought them back for 1530. So here's a perfect illustration of it. 635s, 920. We bought ourselves 2 weeks. We brought in from 1530 to 1650. So we brought in a little bit over $100, about $120. So we brought in $120. We brought in we brought in 645. So now hopefully these calls are not under pressure. Let's see what we can get on this other call that we have here. So this is let's see what this one is, 645, 647. This is the one that we just sold. And this is the one that we're going to, you see how we got today just to the height of 1900, and it's now 16, so $300. Very, very sensitive. So we paid 1650. So let's see if we can at least get that same price. That's a pretty decent price. As a matter of fact, let's see, that's actually us, 1650. You know what? Let's leave this open. Let's go through the rest of the trades, and then we'll see if we can at least get into it to look green before we. Oh, and it's going to go down. You know what? Let's do this. Let's leave it open at that amount. And if it fills, it fills. If it doesn't, that's great. Uh, 690 call, 690 call. So I believe it was this one. sell to open. See how crazy volatile it is now? So let's go ahead and sell a 1730. We think that's going to fill. So 1650 is what we got last time. So the idea is to get at least a little bit more. Let's do 17. All right, let's leave it at 17, see what happens. So that's the idea, and I'm going to leave these 4 just running. I really want to see what happens tomorrow. For all we know, Intuit could dump, or for all we know, it could continue going up. So we'll see. Riot. So Riot is one of those crypto miners, probably the best one from what I've heard. I personally don't know much about it, but I do know a lot of the exposure is Bitcoin related. So I have $7.50 puts that I sold on it. These are obviously bullish because it's underwater. You know, this is really just a play on theta, on time decay. Right now, these are up 120 bucks. I got $75 for them. They're worth about 50. You know, it's going to be interesting to see how crypto reacts. I believe, if I'm not mistaken, I bought back 10 at 49. So I've taken some chips off the table. I only have 5 here that I'm just going to let ride. And then I have some 650 puts, which is kind of the same situation. They're for next week. If it goes down to 650 Riot, I will open a lot more of these 650s. And as a matter of fact, what I will do with these is these were actually just opened up yesterday. So I opened up this trade yesterday. So I'm going to let this trade just run. Clean Spark, we covered Palantir. So let's cover Palantir. I had tweeted about a put option that I had opened up. You know, if there's one thing that I've learned is never get in front of a stock with momentum. You know, if you see a stock that has momentum, you never know what could happen. It could continue running for another 2 weeks. At that point, it's not really fundamental based. It's really just volume based. And so I opened up that position when it was like around here. I was able to sell it when it was around here. So I did get very lucky. You know, this was what, 10:15 a.m. And I think I sold these at 5 hours ago. So this was like at 10:19 a.m. So I was able to, I got lucky that it got timed at the right amount, because I was able to just get rid of that position. You know, Palantir, while I do think it's overpriced, it's got a lot of momentum. You know, so pretty much what I have here is I got rid of my $28 puts that I had. I had already gotten about 80% of the premium, so I got rid of those. I have one $28 call expiring next week. Again, I'm probably just going to keep rolling this. Right now, let's see, we got Palantir, and then our last position is really SoFi, and Tesla. Both of these have been doing really good, and in both scenarios, and this is a personal lesson I've learned, is in both scenarios I've gotten caught underwater. So all my 100 shares or 1,000 shares or 900 shares are long dated because I had to roll them out in order to capture the upside, which I'm fine with. You know, if you actually go into my Twitter, I did the math on Palantir on what the math looks like if I was to just let it get assigned now or roll them out a year out, and the returns get pretty interesting. You know, you're talking about 40-50% returns. So with this particular trade, I'm doing the same math on it, right? I'm looking at the math of taking into account the premium, taking into account the capital appreciation from my basis, $7.44 to $8, and taking it into account what the percent return is of that trade, it makes a lot of sense for me to keep it, you know, and because now I don't have to worry about that, you know, however much money I have tied up in SoFi, which is close to $7,000, probably less, 744. Let's see, 744 times 900. So I have about 6,600 tied up. Now I know that for that particular $7,000, I'm getting a really good return on it. So I look at it as sort of like a hard money loan. You know, what if somebody said to you, hey, I need to borrow $7,000 and I'm going to give you a 50% return? but you can't touch the money till 2025. It's really, it's a no-brainer. We get a bit greedy and we get a bit we lose sight of what the returns look like, and they're phenomenal returns, right? So for example, on this $8 call, sure, I don't see the money, and this is not even taking into account the premium I've collected on these shares looking back. This is just strictly looking at this trade. I collected a credit of $1.18, and if I get them assigned, that's at $8, right? So if I look at $8 times 100 is 800 plus my premium, which is 118, that's 918. So if I look at 918 minus my cost basis, which is 744, that's $174. So if I told you could make $174 on $744, right? That is a 24% return, 23.38. So look at it like if you're a real estate investor. If somebody came to you and said, hey, I need a hard money loan, which by the way, just your attorney fees, your due diligence, I feel like your risk is a lot more than this particular trade. But if they said to you, hey, I need the money for till January. So that's September, October, November, December, January. That's 5 months, not even 6 months. If I analyze this return, you're looking at 45%. So just for 5 months, he's like, hey, just for 5 months, I'll give you 24% return on your money. That is a phenomenal return. And that is how you have to look at these trades. The activity over trading is not correlated to your returns. So don't think that because you have to be rolling every week and you have to be actively looking for is the way to grow your account, because it's not. The way to grow your account is by looking at trades as bricks and maximizing the returns that you get on each brick. Because if you get 30% yearly on one brick, 40% yearly on another brick, 50% yearly on another brick, then your average, when you look at your portfolio, which in turn is the wall, when you continue this analogy, then you're looking at 40, 50% returns on your wall. And that's exactly what I've been able to do. We're looking at 41% return, and not with a lot of risk, to be quite frank. Nothing that's kept me up at night, nothing that I've been having to check the market daily to see what happens. I just came back from a 9-day trip climbing Mount Kilimanjaro in Africa, and I didn't have a single bit of internet, but that's fine because I rolled them out till after I got back, whatever trades I had, and that was the end of it, and that's the beautiful thing about option trading. Another another trade that I have here that's a phenomenal return that I just forget about is a $7 TSLL put. TSLL is leveraged Tesla. Right now it's trading at $10.68. So I feel really good about this trade. It expires in December. I got $100, right? So $100 for $700 of collateral. I mean, can somebody tell me what that return is? What is that? A 14% return? That's a 14% return in from 9 to 12, 9, 10, 11, 12, September, October, November, December, 4 months. So in 4 months, we're looking at a 14% return. You see? So, and truthfully, this is with margin. This is free money for me. This is absolutely free money. So the return is infinite because you're not paying on this. This is an infinite return. Okay. So long story short, those are pretty much all the positions I have open. Tesla is another one of those that I'm just continually rolling out. And it's the same math as that we just went through with SoFi. Same math as in SoFi. Right now, if you look at my market value, right, 228 if I hadn't sold any calls on it. And that's fine. I understand that. But the reality is that I'm okay having these shares tied up, and I'm just going to continue rolling them out. 205 in December. If I roll these out till December of 2026, I can probably roll them up to 245, which at that point, if you look at it on a return basis, it's more than an ample return, right? So that's pretty much it as far as the portfolio goes. It's 3:50 p.m., so market's going to close in about 10 minutes. We have been going now for 35 minutes, so I do like to keep these to a maximum of 30 minutes in and out. If you guys have any questions, I am checking I'm checking online right now on my X and my YouTube to see if anybody has any questions. I don't see any questions right now. If you guys, I'm also available via DM. I am more than happy to help you guys. It's really about passing it forward. There's a lot of great traders out there. TJ the Wheel Deal being one of the most influential follows that I've had. Really has challenged and made me grow as an option trader. And really it's just about passing the ball forward, and that's the idea with these things. So with that, I'm going to check YouTube really quick, but I also think that we are okay with YouTube. So having said that, thank you guys. Thank you for joining 36 minutes. I appreciate you. Hit the follow me on YouTube, subscribe, or hit me up on X. I am very available. Happy to help you guys with your trades, and let's make a lot of money. Take care, guys, and I will see you closer to Friday, so that way we can go through expirations and rolling. Okay, so stay tight, and good luck out there.